Okay, excellent. So yes, we're going to take a look at AltaGas. So this is a company that I've actually answered a few questions on for clients over the past year or so. It has a history which we're going to get into, but anyways, AltaGas it's a utility, regulated natural gas utility, and also midstream processing company. A symbol is ALA on the Toronto Stock Exchange, trading at about $29 right now, $8.6 billion market cap, and it pays a yield of 4.1%. So at its core, it is a natural gas infrastructure company. There's two sides to the business. About 55% of the business is utilities. So this is regulated gas distribution, primarily in the United States. 45% is midstream, primarily in Western Canada. So these are assets like gas gathering and processing, natural gas extraction, transportation, and storage. So if you look at the company's performance over the last year here, pretty impressive. It has a nice 12-month chart. Longer term, a lot of volatility in this company. And we can see if we go back to 2014, 2015, the stock was trading at about over $50 per share. Had a really rough time for several years after that. And then just more recently, it's been recovering. So there's some history here which we can talk about in a couple of slides, but let's take a look at the current financial situation of the company. They recently put out their Q4 financial results. Good results overall. Adjusted EBITDA up 10.6%, normalized net income up 13%, and then normalized earnings per share 75 cents, up almost 12%. Now, for the full year, results were really more or less flat. Adjusted EBITDA up about 2.4%, net income down 1.5%, as were normalized EPS of $1.89, which was down 1.6%. So looking at the guidance for 2024, looking forward, the company is expecting to increase its normalized earnings per share by about 10%, getting to about 205 to 225 per share in earnings. Adjusted EBITDA growth in the range of 11%. They have $1.2 billion planned for investing capital over the year. And they also are doing a 6% dividend increase. So that was just announced recently in March. Longer term, they want to continue to deleverage their balance sheet. They're targeting about 4.5 times net debt to EBITDA. And they're looking at long-term annual dividend growth in the range of 5% to 7% per year. So when we break this down across its business, one of the things that we often look at with utilities is whether or not the revenues and the EBITDA are contracted or regulated, or whether or not there's exposure to commodity prices and volumes. So in the case of AltaGas, we can see for 2024, they're expecting about 54% based on take or pay or fee for service contracts. So this is essentially stable, recurring revenue, highly visible, supports a sustainable dividend, and about 46% is based on commodity prices or volumes or differentials in commodity prices. Long term, they want to increase their take or pay and fee for service revenue and EBITDA up to about 70%. So really, this is the higher quality cash flow for the business, and we can see that 54 to 46%. That really reflects the breakdown of the company. With respect to utilities or midstream, it was about 55-45 utilities midstream. So basically that take or pay comes down to the utilities, and then the more fluctuative EBITDA is attributable to the midstream business. Taking a look at the balance sheet, one of the things that's really important to analyze when you're looking at a utility company is the balance sheet, making sure that it's not over leveraged, because this is a capital intensive business. So all of these companies have a significant amount of debt. In the case of AltaGas, a total debt of about $8.5 billion, equity of $7.7 billion. So I would say that the balance sheet right now is fairly reasonable. Debt to EBITDA of about 5.4 times, and the debt to equity of 1.1 times. But I talked a little bit about the history that this company has had and how in the past it was trading at over $50. It went through years of just horrible performance for its investors. And really what this was attributed to was an over-leveraged balance sheet due to the company overextending themselves on acquisitions. So they made a couple of big acquisitions. They're very acquisitive in that 2016 to 2017 period. And the debt to EBITDA got up to about 7.2 times in 2018. So that really took a toll on the company. A few of the assets didn't perform as well as expected. Share price went down, and they really had to do a big deleveraging over the next couple of years. Now, the way they were able to achieve this is they had to sell some of their higher quality assets. They had a very nice a run-of-river hydro asset in British Columbia, northern British Columbia, that they had to sell, that had only been commissioned about a year or two before. There's a few other things, but they were able to get the balance sheet leverage down, which was something they really needed to do. And now, again, they're targeting about 4.5 times, which we would consider to be a very reasonable debt leverage ratio for a utility company. Then in terms of financial performance, the company's been doing fairly well for growing their normalized earnings per share over the last several years. So really good growth from 2018 to 2021. A bit of a slowdown in 2022, but still pretty positive. And then 2023, the year that we just finished here, we saw actually a slight decline. So now they're looking at about 10% growth going into the next year. They had mentioned their long-term target, 5 to 7% earnings per share growth on an annual basis, or sorry, dividend growth on an annual basis. So we would want to see earnings per share growth reflect that. If they're going to be able to grow their dividend sustainably at 5 to 7% without overextending their payout ratio, then their earnings per share need to grow at least that rate as well. So it does seem that it has generally been growing more or less at that rate or higher, and is expected to do so in 2024, just with the exception of last year. But with a lot of these companies, that's just the way that it works. It's going to ebb and flow, the growth. There's going to be some quarters where it's a little bit higher, a little bit lower, but generally speaking, the track record is looking good on that for the past 6 years. Now, in terms of our take on AltaGas, well, the fundamentals have been improving. We've seen some growth in earnings per share, a significant deleveraging of the balance sheet. But more than half of its EBITDA is contracted. Payout ratio is good. I didn't get too much in the payout ratio, but it's about 56% of earnings per share for 2024. That includes the recent dividend increase. So we think the payout ratio is conservative. And then they're targeting that consistent dividend growth in the range of 5 to 7% per year. On the opposite side, growth did flatten, so that's something to pay attention to. They did come slightly below the mid-range of their guidance for 2023. So let's see how they do in 2024. They do have the history of overextending themselves with acquisitions. Now, this is in the past. I think that they've learned some lessons there. It's a new management team, so that probably doesn't really have much of an impact on how we feel about them going forward. Deleveraging, that great deleveraging that we saw was, again, largely achieved by selling some high quality assets. Again, this is something in their past. I don't think it necessarily affects them that much in the future. So our take on AltaGas, overall, we think that it has good fundamentals as utility stock. What we think investors should anticipate from a company like this, just as a general guide, would be a total return in the range of about 10% per year on average. So that's about a 4% yield, that 5 to 7% dividend growth consistently over time. You're getting up to about a 10% total return. So for somebody who has that expectation, we think that the company is well positioned.
Yeah, it's a good way to set the expectations for a company like that. Some people have expectations that are too high, but if that is your expectation for that company, that could be a justifiable position within your portfolio. Typically, we're looking for a little bit more growth than that, but it is a reasonable return in that range.